We felt scattered. I thought, why do we have two different financial advisors? One's doing one thing, one's doing another thing.
We felt sometimes like we were being guided in directions to spend extra money on things that probably weren't always necessary for us.
I would not know for sure if I should put my money in here or put it in there. Should I buy this real estate?
Like, I don't know what to do with this money, and I don't want to just blow it and spend it.
We were concerned about our financial health and just
We felt scattered. I thought, why do we have two different financial advisors? One's doing one thing, one's doing another thing.
We felt sometimes like we were being guided in directions to spend extra money on things that probably weren't always necessary.
We felt scattered. I thought, why do we have two different financial advisors? One's doing one thing, one's doing another thing.
We felt sometimes like we were being guided in directions to spend extra money on things that probably weren't always necessary for us.
I would not know for sure if I should put my money in here.
Hi, everyone. Welcome. I see you flooding the room. Thank you so much for attending today. Apologies for some technical difficulties. We love showing our earned testimonial video, just really talking about how physicians and doctors are impacted by earned. So again, thank you so much for coming. We're really excited to get started today. So thank you for joining us to Thursday, January 29th, your 2026 action plan, tax, investing, and retirement moves every physician cannot afford to delay. Brought to you by Physician on Fire and Earned. So we're excited to, again, have you kick off this conversation with us today, focused on real tax and investing and retirement discussions that you are facing in 2026 and how early and coordinated action can make a meaningful difference. So I'm Amber, Marketing Manager at Earned, and I will be your moderator for this webinar. Earned is a longtime partner of Physician on Fire and the first fully comprehensive tax and wealth firm built specifically for doctors, physicians, their families, and their practices. We bring tax planning, investing, retirement strategies, practice level advice, and now insurance and legal coordination, all under one roof. So your whole financial life works together. So before we get started, I want to go over some housekeeping. I will pull this up so you can see. So we have some awesome webinar features for you today. As you'll see in the bottom right corner, we have a chat. Feel free to say hello. Tell us where you're viewing from. Right to the left of that, we have our questions box. Please put all additional questions that you have in this box so that we can answer all these questions for you when our panel comes on stage. This session is supposed to be highly interactive, so many of you submitted questions beforehand. We're so excited to answer those questions. And again, if you have additional questions, put those in that question box. We also have some awesome polls for you today. So please click on the polls on that down right-hand side of your screen there. We have 3 polls up so far. So go ahead and take some time as I'm introducing our panelists. Take those polls so we can learn more about you. All right, so today we, of course, have joining us is Jorge Sanchez, the founder of Physician on Fire. He's a trusted voice for all of you physicians pursuing financial clarity, independence, and long-term sustainability in demanding careers. And joining him today is Hayden Werhan. He is a CPA and a financial advisor at Earned, where he helps doctors and physicians make coordinated tax and wealth decisions, especially as rules change across years and income levels. And also joining us today is Nick Gazzarelli, Senior Advisor and Retirement Plan Specialist at Earned, working closely with physicians on retirement plan design, investment options, and strategies that align with both tax and long-term goals. So thank you to our panelists for being here. We're going to get them on stage and get them kicked off with our panel style. So we're going to start with Jorge today, talking about the physician mindset, what really is uncertain for physicians in the 2026 year. And then we will dive into the rest of our questions that you have brought to us and that we want to cover with you for our tax, investment, and retirement updates. So welcome, panel. You can wave, say hello. Awesome. So Jorge, like I said, I really want to start with you, okay? From what you were seeing from the Physician on Fire community, what are physicians most concerned or confused about as they look ahead to 2026?
Sure. I mean, so thank you very much. I spent a lot of time in the Facebook group. I think we're about 50,000 certified doctors in it. I'm in there and I read a lot. So there's a lot of, nervousness, especially at the beginning of the year. There's a lot of questions about taxes, about retirement changes and investment uncertainty. First, there's good news. The One Big Beautiful Bill made some of the tax brackets permanent. So there's definitely a plus on that. I saw a lot of questions on that. There's a lot of confusion, and I think one of the baseline or the cause of it is that, we have 3 generations of physicians. One cause because we have increased age, we're living longer. Doctors are retiring later rather than earlier. And you have 3 generations of physicians. We have the young physicians who their style is, I value experience. I want to retire early. Versus the older generation who says, hey, I'm going to work longer. And then you have this middle group. And what happens is across physician lounges across the US, you have these 3 generations giving advice to each other. And there's just so much complexity in that. And could you imagine a recently graduated resident who already has, wants to invest in real estate, sitting at a table with someone who already has his portfolio almost fixed in stone because they're close to retirement. So what I see is a lot of noise. And when you add to that crypto, you add AI, what has happened to this in the world of advice, financial advice, is it's a good thing. The good thing is that there's better products, better services. There's more choices. Rather, your path to retirement is not one path. There's multiple paths. But the important thing is that good advice has increased in importance because of so much noise. That's why at Physician on Fire, we want to educate our audience as much as I can so that you can choose the path forward. So that's one thing that we've seen. Another thing is this mandatory Roth catch-up rule. There's a lot of active discussion about it and questions. So we're going to talk about that. And then there's market uncertainty, right? And the uncertainty is real. After 3 years of double-digit returns, valuations are stretched, and you got to expect to have some volatility. So I think the big thing, the physicians aren't anxious about one thing. They're anxious about whether all these pieces will work together and where they fit in it and where it happens on their journey to retirement.
Absolutely. Thank you, Jorge. I really feel like you hit a lot of the pain points that people submitted questions to. And I really do want to kick off with one of the big things you talked about. Hayden, we want to jump right into, can you explain the new retirement catch-up provisions from the One Big Beautiful Bill for us?
Sure, Amber, I can do that. And it sounds pretty straightforward, but it is actually pretty complex. And the complexity comes into play with regard to what employer one has that is sponsoring a retirement plan. The catch-up provisions are basically age-based. So if you're under the age of 50, if you're looking at a 401k plan for 2026, we can put in $24,500 of our wages. That's a salary deferral. Most 401k plans, by the way, let you treat that either as Roth or traditional, but that's Nick's department. If you're over the age of 50, you get an extra $8,000 that you're able to defer into your retirement plan, 401k, 403b, et cetera. Congress created a new layer of catch-up provision, the super catch-up, and that's for people aged 60 to 63. So if you're in the age of 60 to 63, you get to put away an additional $11,250. So your 401k goes from 24,500 to 35,750. Really, really a nice benefit. However, the trick with the catch up is that if you had wages in the prior year from the employer who's sponsoring the retirement plan of $150,000, then your catch up deferral is treated as Roth. I'll just do that quickly again. If you have wages of 150 or more in 2025, your 2026 catch-up provision has to be treated as Roth. And there's a lot more details to that, but we can take questions later in emails or what have you, and be happy to answer them in more detail.
Nick, from a retirement standpoint, can you add on to, how is this affecting the high earners and the physicians for the retirement area?
Yeah, so first off, thanks for having me today. Always a pleasure to speak with you all here on Physician on Fire. And always throw a little disclaimer out there. If I have any technical difficulties working from a home office here, bear with me, I'm quick to get back. So with that said, Hayden's exactly correct. He nailed it as far as the contribution limits and the mandatory Roth catch-up. A couple pitfalls or nuances I just want to highlight and expand upon. We are talking, as Hayden said, the same employer. So if you switch jobs or you go self-employed or go from self-employed to a medical group, those are changes in employment. So therefore, you may be buying yourself one more year of pre-tax catch-up contributions. So very important that when you're looking back to 2025, were those wages paid by the same or related employer? Second, I'll say, is we are talking about FICA wages. And why that's important is if you are a 1099 independent contractor and you do not maintain your own corporation, maybe your per diem, whatever it may be, but if you're not receiving that income on a W-2, IRS doesn't care about it. I mean, they care about it for taxes, right? But they do not care about it for purposes of this mandatory Roth. And kind of to go back to the question there, what are we seeing? What is this translating to as far as forward-looking planning or strategies? First off, it's forcing Roth on people who maybe have never contributed to Roth before. And that's not necessarily a bad thing. There are a lot of benefits to Roth, right? I think in past, I've spoken to you all about the idea not only of asset or investment diversification, but also the idea of tax diversification. Having three buckets, a pre-tax bucket of money, a taxable bucket of money, and a tax-free bucket of money is extremely important and valuable when it comes to, let's say, retiring with dignity, meaning you're not giving all your money away after a lifelong career of working. And so we're seeing strategies as far as Roth conversions. We're seeing strategies as far as additional pre-tax opportunities. If you have the benefit of access to something like a cash balance plan or other deferred investments, those are things that can help maybe offset some of the pain that you feel today because you're losing a little bit of a tax deduction. So a lot more creativity in that space, and a lot more physicians who are coming out and saying, look, I know these other strategies exist. I think it's time I learn more and see if they're applicable to me.
Great insight on that. Thanks, Nick. And I want to keep expanding on one big, beautiful bill. So let's jump into that. What are the updates for 2026, Hayden? I know you kind of have a laundry list for us. So if you don't mind sharing.
Sure. So for 2026, the tax brackets are all made permanent. They index for inflation, but we don't have to worry about, going back to that 39.6% top tax bracket. It's 37%, and the brackets are quite broad and pretty favorable compared to what they used to be. So the big beautiful bill made the tax brackets from the Tax Cuts and Jobs Act of 2017 permanent. With regard to estate taxes, we all have an estate tax exclusion amount, and the Tax Cuts and Jobs Act increased that quite a bit. It was set to sunset at the end of last year, but it was made to be $15 million, which is indexed for inflation starting in 2026. So we can we can leave $15 million behind, and there will be no estate taxes related to that. Other changes for 2026 are the new Trump accounts. We saw some questions about that, and we'll dig into that more. Some negative aspects of OBBA: no more electric car tax credits, and no more solar energy on your house tax credits. And the solar energy tax credits are pretty important. Solar on my house, we contracted for it in September, and believe it or not, it was like, December 28th before we got fully connected to PG&E and would be considered legitimate for 2025. So unfortunately, no more solar in 2026. Maybe that'll change in the future with new administrations, but that remains to be seen.
Thanks, Hayden. That's a really good overview. I know you said you wanted to jump into Trump accounts. I'd like to actually do that now so we could answer some of our pre-questions. Do you mind touching on those? And I'll actually put a resource link for everyone.
So the Trump accounts are pretty neat. I had a cheat sheet up on my screen. Let me find it. The issue with Trump accounts is basically they're a new saving vehicle for children. And there's two groups of children that really need to be separated in this discussion. Children born in 2025 and 2026 are in one group. All the other children who are under the age of 18 are in another group. And the distinction between the two groups is that for children born in 2025 or 2026, if you open a Trump account, the government funds that account for you with $1,000. That is huge in the grand scheme of things, and in the way that other tax credits and so forth are being taken away. It's really a step to look at the future with these plans. So you open a Trump account for newborns, $1,000 goes in there, and then you're able to fund the accounts at $5,000 a year. And sort of a hybrid between a College 529 plan and an IRA, pretty unique plans. For everybody else under the age of 18, you can open the account, put $5,000 a year in, and you're off to the races. A couple of tricks with the Trump accounts. We will have a tax form that we can check a box or what have you, form 4547 in our 2025 tax returns to make an election to open a Trump account. So when you have your taxes done and you have anybody that you want to open a Trump account for, make sure that that election is made in your 2025 tax return filing. Alternatively, you can go to the link that Amber's sharing for Trump accounts, and after July 1, 2026, you can open a Trump account. So that's a magic date. Nothing happens until then. And those are the main points. One of the things that I wanted to research and confirm, which I did, is that once the child, the beneficiary, reaches the age of 18, that account becomes an IRA, like any other IRA. And if you think about someone at the age of 18, maybe they're working and earning, maybe they're in college, but that IRA can be converted to Roth. And at that age, generally in that tax bracket, that would be a grand slam. So Trump accounts can be opened right alongside Roth IRAs and 529 accounts. They can be converted to Roth at age 18 and they grow tax-free for the rest of that person's life. After that, all of the regular IRA rules apply.
Really interesting, Hayden. I think that's a really good takeaway for 2026. And I'm kind of leaning into more of the IRA questions that we're getting. Jan had a question for you, and kind of Nick can dive into this one as well, is how do I best estimate when to do backdoor Roth IRAs? There's something called a BETR calculator. Do you mind both or one of you kind of telling us about that, helping Jan get some guidance?
Well, I'll go. If you have the ability, meaning can afford it, I think Roth IRA contributions should be made by everybody. There are income limitations that we have to take into account that help us determine, can we fund directly into a Roth IRA, or do we fund a traditional IRA and then convert it to Roth? It's kind of a wacky setup if you think about it. You have an income limitation. If you earn over X dollars as a single taxpayer or married filing jointly, you can't make a deduction contribution to your Roth IRA. Anybody can contribute to a traditional IRA, not deduct it, and then after the deposit percolates a little bit, convert it to Roth. So anybody can get money into a Roth IRA. It's just a matter of which direction you have to go, straight into it or through the backdoor process. So yeah, if you can afford it, do it. There are a lot of gotchas with Roth conversions, and it's a very long discussion. If you have other IRA money out there, there's a thing called the prorator rule that you'll run afoul. So be very, very careful about that. But in general, if you can afford it, do it.
Yeah, and I'll expand on that a little bit. One of the prior webinars we actually did with this group was all about Roth, and we talked about this in a little bit more detail. That better calculation of the BETR calculation that you were referring to is the idea of what is my break-even tax rate? Because when you're talking about Roth versus pre-tax savings, it is all a tax game. Think of it as a teeter-totter, right? What is your tax rate today and what is your tax rate ultimately when you want to spend that money? And to win the game, you need to be saving taxes when it's at a higher rate. Now, the tricky part is there's no guaranteed way of being able to do that math today. There is a lot that income can impact one's tax rate. Your marital status, for one, your residence, state of residency, for another, and of course, income for a third. And let's not forget a big one, regulatory changes, right? There's been a lot of things out there, discussion of it a while trying to cap the lifetime amount that you can have in a Roth account. And this is the government's way of trying to say, we want you all to save for retirement, but we don't want to increase our deficit at the same time. Like, how can we collect some tax dollars, or how can the government protect themselves from you sheltering potentially billions in a Roth by doing some sort of lucrative startup strategy in a Roth account? So there's all these different aspects of the tax game that make it very difficult. That better calculation, what it's doing is it's taking assumptions. It's saying, how much money do you make today? What is your tax rate? And how much are you looking to convert? Now, let's look in the future and make our best guess at what your tax rate will be at that time. And the calculation is pretty slick, because what it will do is it will tell you in a numbers format, based on these numbers alone, yes or no, this makes sense. Okay. Now, it's only as good as the data that we put into this kind of modeling. However, back to Hayden's point, Roth generally results in better outcomes because you are securing your future with a tax-free bucket of money. So if you can afford the tax bill today to contribute to Roth, that has a very large weighting on whether or not Roth makes sense for you.
Excellent. Yeah, that was a good expansion on that. And Catherine had a question that really relates to that, and you might have touched on it. I just want to make sure her question was completely answered. But can you comment on the wisdom of Roth conversions from an IRA to lower RMD taxes later?
I can chat about that. I actually was meeting with a client this morning, and we went through that very exercise. So Dr. Sanchez talked about, different stages of life, and one of those stages is when you're in retirement. And managing your tax brackets with regard to Roth IRAs or traditional IRAs in retirement is very, very important. Our financial planning program has an awesome illustration that shows for people in retirement or any age, but when you're in retirement, when your income is a little lower, if you do Roth conversions, what happens? So the client this morning was a retired doctor, $3 million or so in rollover IRAs. And for 2026 and 2027, they're going to have a fair amount of income, but after that, they'll have very, very little income, just interest and dividends. When you reach age 73, you have to start taking money out of your IRAs, required minimum distributions. And those required minimum distributions go up every year based on the charts and formulas. So they can be in pretty high tax brackets when the monies come out. So we did a Roth conversion analysis for this client this morning, and we told the program we don't want to pay more than 22% tax on the Roth conversion. The client is 63, so we'd have 10 years of Roth conversions before their required minimum distributions. By paying the 22% tax now instead of 35% tax later over their lifetime, they save about $250,000 in taxes. That's a lot of money to save in taxes over 25 years or so. However, the other benefit is by saving those tax dollars, you end up with more wealth. But down the road, when you pass and those IRAs are inherited, if you've converted some of the IRA money that you have to Roth, you're saving that beneficiary huge tax dollars as well. If you're not a spouse and you inherit an IRA, you have to take the money out in 10 years' time. If you have a chunk of that inherited IRA money as Roth, you still have the same 10-year rule, but who cares because it's tax-free. So not only are you increasing your own wealth, saving taxes, you're passing more along to your beneficiaries in the future.
Great explanation, Hayden. Thank you. Nick, was there any color that you wanted to add from the retirement perspective on that besides tax?
There's not a whole lot. So the RMD, the required minimum distribution rule, applies to qualified retirement plans like 401ks as it does IRAs. Historically, Roth 401k was not excluded from the RMD requirement. That is a recent change. So just throwing that out there for those of you that may be near or at RMD age, the 401k plan now mirrors the IRA rule, where we get to exclude the Roth balance. And think of it this way, the IRS has already collected their tax dollars on that. So they're not going to penalize you and force you to take it out of your account because it is not generating any tax bill.
Really interesting update there. And Hayden, you had mentioned, trust. David had a question specifically about a revocable trust, whether it's still appropriate for states that have an inheritance tax. Is there something that you can guide him on with that?
Sure. So trusts are super important. And typically they're vehicles to help with estate planning, meaning don't pay a bunch of tax when you die. However, they're also important, even with the very, very large estate tax exclusion that we have, they're also important to say who gets what happens to your assets, and it affords protection of those assets over your lifetime. So having a trust, wills, all of that estate planning, powers of attorney, it's vital regardless of taxes. As it relates to states that have state taxes, absolutely. You should have wills and a trust anyway, and you're just protecting yourself from state estate taxes with that trust planning. One other comment. There's attorneys that do wills and trusts. Then there's estate planning attorneys. So think of a family practitioner being the attorney who does wills and trusts and a bunch of other stuff. Think of the pediatric cardiologist who is highly, highly specialized. That's an estate planning attorney. It's a completely different ballgame, and it's really, really important to have an estate planning attorney that's all they do.
Awesome. Thanks, Hayden. I actually want to change things up a bit. I want to jump to Nick and really bring in alternative assets. So many questions on this, but we're really seeing renewed interest in this inside 401ks, including private equity. What should physicians understand before assuming this is automatically a good idea?
Yeah, so this stemmed from an executive order in 2025 from the Trump administration around green lighting alternative asset classes in qualified retirement plans. I believe it was maybe August or sometime around then. And what this really means is that it doesn't mean that there's an order out there requiring this or telling investment providers, hey, you need to offer this as an asset class in a qualified retirement plan. But what it says is you're not necessarily going to get in trouble if you offer this. It's not a red flag anymore. Now, I will give you some additional history. This is not the first time an executive order to this effect has gone into play. Actually, during Trump's first administration, there was an executive order. Then with the administration change, it was kind of dialed back. And now here we are yet again with another executive order in 2025. But to the point, as it stands today, there's an increased interest in alternative asset classes. And that has been fueled by a few things. Jorge touched on this at the very beginning. Double-digit returns continually year over year brings uncertainty and potentially fear to the investor, because the question is this sustainable? And the numbers suggest no, right? Double-digit returns forever is going to create a chart that goes straight up, and that just does not appear to be sustainable. And so with that, there have been kind of somewhat of a flight or an increased interest in, well, what can I do to protect myself without risking too much growth potential? Like, we all want the world, right? We want the best of the best. We want our cake and eat it too. I want to lower my risk, but I want that equity-like return. And so what we're seeing is interest in things like private equity. Private equity is a scary term for someone who hasn't dabbled in it. But really, think of what the words private equity really means. It just means a company that is not publicly traded. And there have been some innovations out there. And if I had this pie chart, I would show it to you of like all the US companies in the country, and maybe 5% of it is actually publicly traded, right? So there is all this business happening across the world and in the country that is not publicly accessible with a mutual fund necessarily in your IRA or 401k. Private equity offers additional diversification in the sense that you can tap into some of these other very reputable, successful companies who are not their own ticker symbol. And there have been innovations in this space in the form of mutual funds, where you can buy a basket of private equity companies, just like you can the S&P 500. So it is a great way to introduce oneself to this asset class without necessarily feeling like a hedge fund investor or a private angel investor where you're going out and picking a specific company to bet on. The other asset class I will mention that I'm seeing increased traction is called private credit or alternative lending. And this is something I see quite a bit in the qualified space, in part because its tax efficiency is not that great. It's spitting out income, ordinary income, which can be expensive from a tax standpoint. But if you're looking at a tax deferred or a tax exempt account, we're talking 401ks or pensions or cash balance, this is a great vehicle where you can invest in a direct lending strategy, meaning you are acting almost as if you are the lender, lending money to companies for different purposes, and your rate of return is in the form of interest payments on those loans. And I could spend a whole hour talking about just the pros, the cons, the dynamic nature of this asset class. But people who are looking to this asset class are doing so because they want to try and pull some expected risk off the table, but they want a rate of return that's maybe expected to be a couple percentage points higher than fixed income today. And so we're seeing a lot of interest in those spaces, not only from what we're seeing in the news, the executive order, but also just the dynamic, the nature of where the markets and asset classes are going.
Really good. I really like that. And you brought up that term risk, right? Which kind of gets people on the edge of their seat, whether they like to take risks or not. I have some questions kind of related to that. So let's start with you, Nick. Is a tax tornado inevitable? We saved 401k millions, but can't convert enough, even filling 24% of the bucket. Maybe you can start with that, and then Hayden can kind of finish that one off.
Yeah, I appreciate that, because I was going to tag team with Hayden on this one, because from a retirement planning and a savings standpoint, remember, just because you saved millions doesn't necessarily mean you're going to spend millions. Part of one's financial plan is legacy planning, and so it sounds like this doctor is on the right track in that they're being mindful of their Roth conversions. They're looking at their tax brackets to make sure that does it make sense to continue to convert extra dollars, or is that jump to the next bracket mean it's time to stop? And I know that's something that Hayden does with his doctors quite a bit, helping them calculate what is the optimal conversion amount. And the good thing about paying tax, right? It means you made money. So there is a good side to that. But is a tax tornado inevitable? Well, if you're planning in retirement to cash out that millions, I'm going to say yes. You spend $2 million in 1 year. Well, you're gonna pay the tax for that. Are there alternatives besides just the Roth conversion up and top to the tippy top of your marginal tax bracket? I'm actually going to pass that over to Hayden, because I think he'll be better equipped to answer that part of the question. But my quick synopsis of how the question was asked is it sounds like a good strategy is in place there to be tax mindful when calculating how much you want to convert to Roth in any given calendar year. Hayden, over to you, please.
No, that's spot on, Nick. I think one of the things that needs to be considered with Roth conversions in the sort of universe that Jim is talking about, meaning millions of dollars, is what's the ultimate purpose of that money? Jim is probably never going to spend all of the money in the IRA. If Jim is retirement age or close to it, maybe the portfolio is allocated relatively conservatively. One thing that we can look at is the next generation. So if we allocate a portfolio that we know X percent of is going to get inherited, that person, those beneficiaries or that beneficiary has their lifetime to have, invest, and use that money. So it could be that it makes sense to allocate the portfolio a little more aggressively than you might for your own purposes. along those lines, it might be that we want to consider filling up a larger tax bracket, converting more now, paying a little bit more tax now, so that less tax is paid down the road by the beneficiaries. So, maybe we go up to 28% or what have you, or we creep X percent into the next top bracket, but we're saving, the beneficiaries 37% and whatever their state bracket is. So bracket planning for the current IRA owner is important, but you might have a different answer if you're planning for the next generation.
Absolutely. And I know there's a lot of concerns with planning for that next generation, and also just having all these moving parts. Jorge, I want to give you a chance to kind of jump in before we continue with some of these other questions. But how do you personally handle all of these moving parts that you've been hearing today, from the taxes, the retirement? There's a lot going on. So how do you as a physician take
Yeah,
this
I
on?
think, yeah, thank you. I think the question is like, how do you know you even have too many moving parts? And I think that two events have to happen for you to have like a wake-up call. One is if you see yourself scrambling and stressing out, meeting deadlines and even missing them, when you rush, you're going to make mistakes. So that's number one. Number two is when you make mistakes that cost money. I'll tell you a story that happened with me. I was working I'm in Florida now. I worked in Arizona. I was an independent contractor. I was doing, I was a 1099 and I was getting I had my own LLC. So all the money, all my income went through the 1099, which was based out of Arizona, which by the way has has a state tax. I was paying taxes and I moved from Arizona to Florida about 3 years ago. And I started doing some work here, some 1099 work here. And then I got taxed from Arizona because I was getting paid while working in Florida. I told them to send it to my LLC. I never closed the other LLC. I never thought of opening up my own LLC here in Florida. And guess what? That mistake cost me tens of thousands of dollars in taxes to fix and just go through that in distress. And that's when I realized that I had too many moving parts. So I think to answer your question, I think it's four things. Like first, you got to accept you can't optimize everything. I know physicians hate that. We're trained to get it right every time, but when you focus on avoiding big mistakes that cost a lot of money, especially as physicians, because our income, right? We go to undergraduate, we go to medical school, we start making money late in life, and now our horizon is shortened. We make a lot of money, but we go fast. So when you go fast, mistake is more costly. So I think that's number one. Just got to accept that you can't optimize it. So what I did is I started just scheduling my time with my CPN advisor 2-3 times a year. I don't just wait to the last minute. So I actually put on my calendar. I put on my wife's calendar, and we go and we meet. I think if you just meet 2 to 3 times a year, especially midway, even early, you'll catch mistakes, and you'll at least know which way you're going. So that's a big thing. But again, you gotta have a buy-in from your spouse, which my wife does, and she stays on top of me because I'm distracted by so many things. And then I use simple decision frameworks. Like if you have a Roth catch-up rule, am I over 50? Did I earn over 150,000? Does my plan offer a Roth? Yes, yes, yes. Then the decision is made. So if you keep simple frameworks, I think that's very important. And the last one is I focus on what I can control. Saving assets, asset allocation, tax coordination, and I let go of what I can't, like Fed policy or market returns. I don't worry about that. And of course, delegating, and I delegate to my CPA and my advisor, because I know I have a complex life, and I know a lot of physicians have complex life. The challenge is that you have to know that you have too many moving parts, and sometimes I hear, I talk to a lot of physicians in my groups, and I hear a lot of mistakes, and they ask me advice, and at some point there's not much I can do for them to fix the damage.
That's awesome, Jorge. Thank you for sharing. And I think that just brings more light to what's really happening in a physician's life. And that's, what Earned is for. That's what our group of services and advisors do the best at. Is we are just so specialized in that area for you guys. So we do have 2 questions that you actually hit on, right? Like you said, it's important to meet with your advisor, your CPA. So I actually, Maria wants to know, Hayden, when is it time to fire your CPA and hire a tax strategist, or should the 2 work together? And then we'll kind of jump into, wait a second, how do I get my CPA and then investment person to work together? So there's kind of a multitude of avenues there, but if you can get us started with that.
Well, it's a good question, Amber and Maria. The answer that we have is basically what we've been building at Earned, which is, everything under the one roof, totally coordinated. But CPAs, it's in their DNA to be historians. So if you're having accounting done for your practice, or if you're meeting once a year to do taxes, the CPA is always looking at what happened. What did you do last year? Here's your tax bill. What did you do last year? Here's your profit and loss statement. CPAs, financial advisors, estate planning attorneys, your whole team needs to be looking forward, meaning proactive. So what does it mean in the middle of the year when your profit and loss shows, this expense for medical supplies, or this expense for rent, and this profitability? How can we mitigate a tax bill that we're expecting for the year, before Labor Day? So meeting with people, getting them all on the same team, it's vital. How do you do that? You sit down and you look people in the eye and interview them and tell them, look, here's what I need. Don't be afraid to send me a bill because I want this. Don't assume I don't want to spend some money for professional services. So if your team isn't coordinated, get a coordinated team, get people that understand medicine and what doctors are all about.
Thanks, Hayden. That was great. And so speaking of professionals, right, we have some polls going on and we know a little bit more about our audience now. So it looks like 33% W-2 and 1099. We have about 30% practice owners or partners, 22% W-2 only, and then around 15% 1099 and locums. So I kind of want to get into some W-2 talk for those that are in that biggest bracket there. So
can I comment on that just real quick?
Of course.
Just look at the spread of the diversity of the docs in this, right? And this is pretty representative. 80% of US physicians are employed by some corporation, a hospital, or some ambulatory clinic. Look at the complexity, and this is why, you don't know what you're missing until you figure out what you're missing, in the sense that there's this DIY kind of advice that we all give to each other. But if you think about 33% are practice owners, that means that you're working in the practice and you have some capital and you have some ownership of that. Like, that's a complex model. I've been a practice owner. Like, there's no way you can DIY that. You're gonna make mistakes that are so big. And the worst thing is, every darn year the regulations change, as we're talking about. Every year the regulations at a federal level and a state level. That's just too much. Unless you have enough time, you sit there at night on your laptop and you're going through websites and things like that and trying to figure it out. It's too complex. The other part is, a sign that you have a poor advisor or a poor CPA is that if they only meet with you right at the very point of the deadline and you start hearing from them, like, they're not the best thing for you, because you're on a path. And if your path towards success, you're deviating and you wait too long and you get told at the last minute, there's not much you can do to change it. That's why meeting, quarterly helps you say, hey, am I doing the right thing? Are we going the right path? Just asking that question. But It means that they have to be willing to meet with you. And guess what? You have to pay a little bit more for that ability. Otherwise, they're just going to get you an email and say, hey, send me this paperwork. They put it into software and you get what you get.
Exactly. Thanks, Jorge. Yeah, I think that was important to kind of call out the demographic a little bit deeper there. Leslie has a question for you, Nick. You know, she can't add any more to her retirement lower cash flow. Any other advice or guidance? What else can she do as a W-2 employee?
Yeah, so as a W-2 employee, like as Jorge said, likely 80% of you in the physician space are receiving a W-2 from an entity that maybe you don't own, that you're a working physician. And again, you may have side gigs or 1099 income. And for those people, the opportunity is enormous, but like Jorge said, you don't know what you don't know. And so there's kind of two sides to this answer. First, if you have the opportunity for 1099 income, that is going to be where the greatest opportunity can come, because you are limited to potentially a 401k plus maybe a match or a small profit share from the medical group or the hospital, depending on your employer. And you can't go to the employer and say, but I want more. You know, they have to manage the company, right, from a global standpoint. And so within the benefits plan, you're limited. Now, that's not to say that that side income, that 1099 income, that could potentially create some great opportunities for you, because that is a separate employer, that is separate stream of income, most likely. And it opens up its own qualified plan or pre-tax savings opportunities, potentially from zero to another $70,000 per year, depending on your specific situation. So I think that's first. You know, if you have 1099 or multiple streams of income, are you maximizing your pre-tax benefits from each of those income sources? And that's a complex question, because now you're getting into like legal rules of, are these two streams of incomes related? And so again, back to what Jorge was just saying, I do not recommend making that determination by yourself, because if you get that wrong, it is potentially damaging. Well, it is damaging if you do that wrong. Second, if you are only looking at W-2 income today, you're maximizing your benefit there. And the question is, what can I do knowing that I don't have 1099 or other income? There are taxable ways, taxable accounts out there that would be something to explore, that can invest in your future, invest in the market, but there are very tax efficient ways to do that. And so I saw Hayden nodding his head over there, because wearing his CPA hat and his advisor hat, I could only imagine how many times he has this conversation of, hey, you have $500,000 sitting in a taxable brokerage account. Did you know there's a tax discussion you should be having about the way you invest that account? And so that would be the next step that I would look at. And of course, there's other strategies, like think of it like a waterfall or a stream, and you're going to do this strategy, then this strategy, then this strategy. You know, we could talk all day about different investment platforms that would apply, and where would you sequence those in your financial plan.
So Hayden, I'm going to now bring it to you, right? What do those tax strategies look like for W-2 incomes? How can we help these physicians?
So Nick hit it on the head, and when he first spoke, he talked about different buckets that you would have money and investments in: tax-free, tax-deferred, taxable. We have a lot of dental clients in our firm, and we talked a lot about private equity. There's a huge private equity component in the dental world these days. So the people who go into private equity are employees once that deal closes, and they don't have the ability to save much more than they can defer into a 401k plan. So they have to do their IRA to Roth conversions. But the wealth that they're going to generate is going to have to come from a taxable investment account, a personal investment account, a personal brokerage account. And when you look at the three buckets of money that you'll have, tax-free, tax-deferred, taxable, there's a concept called asset location. And asset location means the stuff that doesn't make a tax bill every year, you put it in your taxable investment account, because unless you sell something, there's no tax bill. The things that are highly volatile, or a lot of the alternative asset classes that just pay out interest income, those are good for your tax-free, your Roth accounts. And then lots of other stuff would, be in between and go into your 401k retirement plan account. Saving on an after-tax basis is a thing, and it's where a lot of our clients create a lot of wealth. So by allocating between your different accounts, the taxable account is going to have larger equity sort of asset classes in it. And those are asset classes that, again, unless you sell something, you don't have a tax bill. So it's a taxable personal brokerage account, and you fund it on a regular basis, set it and forget it, just like you would your 401k plan.
Awesome. Thanks, Hayden. So we have some very specific questions, and we're actually getting close to the end here of our hour together. I feel like, hey, Jorge, what do you think? I feel like we need a whole nother session just like this, right, to answer all these questions. So I want to make sure we can get to a few more before we call it. If your question did not get answered live, we would love to reach out to you, whether it's here on the question chat box or through email or phone number. We will reach out to you to make sure that your question gets answered. But I want to jump back to a question that we had on the chat here. And that was from Jessica. And she really wants to know, Nick, about the best way to use cash balance plans. Do you mind kind of diving into that for us?
Yeah, and I'll speak very quickly given the time here. So cash balance plan is a supercharged 401k and profit sharing plan, in the sense that if you are maximizing your benefit in a profit sharing or 401k plan, which is $72,000 this year, if you use the plan correctly, and you say, I still want more pre-tax retirement savings, that is doing kind of the simplified decisioning there. If you check yes to those boxes, then cash balance is probably next to look at. Cash balance plan allows an individual to put away potentially hundreds of thousands of dollars each year on a pre-tax basis to a qualified retirement plan. Now, there are requirements. It has to be sponsored by a business, and it has to cover a certain number of employees. But for those of you that are self-employed, this is a fairly easy requirement to pass. For those of you that are private practice, or those of you who are W-2, a little bit more complicated, but worth exploring. The reason you do it is you're sheltering income today, same way you would a 401k plan, but you're doing it on a much larger scale. And I'll stop there because of time.
Awesome. Thanks for answering that for Jessica. A few more things, Hayden, about retirement. For a safety part of retirement for the balance of equities, which bonds are best? Short-term treasuries? I know that's very specific, so if you want to just give some general guidance on that. Ricky always has the best questions.
Well, good question from Ricky. The answer is it's going to depend on each person's individual portfolio and what it is we're trying to accomplish with the fixed income piece of that portfolio. The primary purpose of fixed income in one's portfolio is safety. So we had many years of super low interest rates. And it was really tough to tell a client, look, your financial plan has to include 40% of fixed income. And yeah, sorry, but we're not earning a lot of interest on our bonds or CDs right now. But it's your safety net. When the tide goes out, you're still standing. The answer about the specific bonds is, again, specific to each person's portfolio. There's bond funds, there's individual bonds, CDs, treasuries, and so forth. When interest rates are low, I think short-term makes more sense because you're able to, pivot into a longer-term instrument when interest rates go up. But on a broad scale, more intermediate, I think, would be appropriate. But again, safety is the key.
Absolutely. Thanks, Hayden. So we are running out of time. I see all your amazing questions here. We will not leave you hanging. We will reach out to make sure that your questions are answered. We will make sure that this recording gets to you. I know some of you put in that chat that you have to go to clinic. Totally fine. We would love to send you this and again, answer all those questions. There was a poll that was posted. It says, after today's discussion, what feels like your biggest priority? And almost half of you put, I need to get everything coordinated. Like, it sounds like a beast of a project. And I just want to let you know that that's why we're here, right? Whether it's just talking to us on getting some guidance on who is the best fit to help you through 2026 and beyond, coordinating your tax and your retirement, and whether you're a practice owner or W-2, we really want to make sure that you're set up for success. We know how busy you are. Your time is everything. And so, Jorge, will you give us some key takeaways from today? Really kind of wrap this up so that we can send people off with a good take on this.
Sure. I think that the main point is that if you're early in your career, you can make mistakes, but because of the unusual nature of our being a physician starting late, those mistakes cost money. When you get in your 40 to 50s, if you've saved enough money, you get to an inflection point where doing it yourself is going to hurt you. So I think that the value of an advisor, like for example, Earn, that has one-stop shopping, it's not the convenience, it's just the fact in the ecosystem, everybody talks to each other. And I think that's the value of exploring an advisor that can put it all together, because we just have such complex lives. And the last thing is a nugget for everybody on this call. Like, listen, 80% of us are employed by a company. Like, call human resources and find out if you even have a Roth. If you're over 50 and you make over 150,000, does your hospital or your clinic offer a Roth to be able to do this? Because if they don't offer a Roth, you can't do a catch-up. You have to have another strategy. This way you can adjust your elections. And I think, again, thank you for all the panelists. I mean, I've learned a lot today. Thank you for everybody on this call. Again, we're trying to save America. We're trying to save America one patient at a time. We also have to take care of ourselves so that we retire, because we're all going to be consumers of healthcare on this phone call, and you want to reach it stress-free, as healthy as you can, with some quality of life.
Well said.
Absolutely. Thank you, Jorge. And again, thank you, Nick and Hayden, for joining us today and bringing your expertise. We're going to have to do another session. So we can't wait to welcome you back. And then again, if you're here or you already left, we're going to be sending you this recording and making sure that your questions get answered. Thank you so much for joining us today. Appreciate it.
Thank you, everyone.